sustained realized volatility that's higher than at any point in the last 10 years. This chart actually comes from the S&P Global. So this is from the mouth of the beast itself, so to speak. And this is 1 month S&P realized volatility. And I had a conversation with somebody the other day. We were talking about how elevated that is, and that if you look at the vol complex in general, the VIX is arguably just fairly valued in and around 20. So realized vol looks at how much the market has moved over a given time frame. So typically, like on your chart here, we're looking at 1 month realized volatility. So that tells us how much has the market moved over the past 30 days. And again, that's a rolling window. Implied volatility is a forward-looking measurement. And the key difference here is that generally, the low and implied vol is going to basically be where realized vol is, right? Because you're going to say, well, what's about to happen in the market? Well, what has been happening, right? Those two are just as a general basis for starting. Now, obviously, implied vol includes what traders' expectations are. So if I think a Fed event is coming out, then implied volatility is going to be higher because I know that event is coming. So that means that I have to price that in, right? That's a catalyst for volatility. So implied volatility holds in some of sort of the feelings and emotions and thoughts of what traders think will happen, baked into and on top of what has happened. And that can adjust very quickly, whereas realized volatility is only going to measure the last 30 days. So that tells us, again, what the market has been doing. So I would say for purposes of this presentation, realized volatility tells us how much volatility is currently in the market, right? And I can use that as my barometer for how much market volatility is expected or implied going forward, And what I find so fascinating about this chart is if you look at that red line, you can see that we're at this kind of baseline of realized volatility, sustained realized volatility that's higher than at any point in the last 10 years. Yes, we've had a few episodes, 2018 crash, Volmageddon, March of 2020, where we get this kind of episodic spikes higher in realized vol because the market is crashing, limit down style crashes. But very quickly, that realized volatility has reverted back, right? Market calms down very quickly. And I think historically, that's because the Fed has been accommodative. I mean, in this 10-year period, generally the Fed put is in place, right? Now we don't have that same backing from the Fed, and I think it's a fascinating note here to say that has brought a sustained period of realized volatility that we've not seen in, I don't know if you want to call this a generation, but at least a couple decades. What's interesting is you see that the realized vol increased really at the end of 2021. If you look at liquidity in the E-minis, that's the kind of global benchmark of U.S. futures, equity futures, liquidity really started to drain out in that product around the same time. So I think when the Fed started to jawbone about raising rates kind of at the end of last year, end of Q3, I guess, early Q4, that I think a lot of people really did get the message and started positioning for it.